Okay, can I just be honest with you guys? I'm a bear. I think we're going into recession. I've talked about this before here on the channel, but today we got some really good news that firms up that bull thesis for the bulls out there, for the soft landers. And we're going to go over that data here in this video. And markets are reacting to it. The S&P 500 is up 0.25%, but the equal weighted S&P, which does not take into consideration market cap weightings, is up a lot more than that. You're really seeing a broad-based rally today, and you'll know why when you look at the data. And I also want to be honest with you, I don't think we're getting accurate economic data from government agencies, okay? For whatever reason or another, I just don't think the data is very accurate. I think we have flawed ways of calculating the data, and the worst thing possible right now during an election is to see the economy go to crap. And I think we can all say the economy is likely a lot weaker than the data says it is. Just talk to people out there. If you are on Main Street, if you're an average person, just go out and talk to people. People are struggling. Auto delinquencies are at the highest levels they've been at since 2009. Like, that's not the first thing you stop paying is your car. That's like the last thing besides your house that you stop paying on. Again, I'm sure you guys understand my stance. Here on this channel, I've been very vocal trying to warn everyone of the risk out there, and hopefully we've done a good job of that. But nonetheless, even if I think this data is not correct, that's just my opinion. Wall Street doesn't give a rat's ass about my opinion, okay? The only thing I can control is what I do. Am I excited about this data? No. Is Wall Street excited about this data? Yes, and rightfully so if Wall Street as a collective thinks the data is accurate. Okay, so this is a positive for markets today. So let's start with durable goods orders. Durable goods orders were expected at negative 2.6%. That's because last month was really strong at positive 9.9%. Well, we did get revised lower from 9.9% down to 9.8%. But durable goods orders month over month came in at 0.0%. So that's much better than the expected negative 2.6%. Much better. Now, we also got final numbers for Q2 GDP. We were expecting around 2.9%. We actually came in at 3%, so a little bit on the stronger side. Now, the last update as well for GDP was 1.4% and was revised up to 1.6%. So that was better than expected as well. Now, durable goods orders, excluding transportation month over month, came in at 0.5% positive. Last month, we were negative 0.1%, and the estimate was negative 0.1%. So that came in much better than expected as well. You also got durable goods orders, excluding defense, that came in at negative 0.2%. But the estimate was negative 3.5%. So across the board, this was much better than expected. And that's been my stance. I'm for a while now, I'm really not concerned about the data that we're going to get coming out this month. I'm really not too concerned about the data coming out in October. I think November's data that will be for October is going to be a little bit more on the mixed side, maybe on the negative side, but time will tell and we will see. This morning, we also got initial jobless claims that came in at 218,000. We were expecting 222,000. So this is actually the lowest initial jobless claims we have seen since May of this year. So you're definitely seeing the soft landing narrative starting to be reinforced with some of the data that we are getting. Now, Fed Jerome Powell was scheduled to speak today at 9:20 a.m. He did not make any remarks on monetary policy, nor did he make any remarks on the economy. So it didn't move the markets. We didn't get anything new out of Powell. So that was really a nothing burger. At 10 o'clock in the morning today, we got pending home sales month over month. The estimate was positive 1.2%. We came in at 0.6% positive. So it was about 50% lower than expected, but that's not all too bad. It could have been worse. At least pending home sales month over month are positive. Still, not in a great place, but positive. Pending home sales year over year were expected at -6%. We came in at -3%. So that was better than expected as well. And as I've said here on this channel, if we are going to get a positive surprise to economic activity, it's going to be in the real estate market. Not with prices of homes going higher, but if we can actually start to sell homes, if we can start to see transactions get moving again, that's going to provide a lot more liquidity to household balance sheets. That's going to give people a chance to spend more money. The problem is the amount of homes listed is up almost 300% since March of 2022, so almost 3 years ago, whereas the mortgage applications are down about 60% from the same time period. So less demand, higher supply. If price is in the middle, right, that does compress price, and that could be a negative for the economy as well. I think time will tell again what happens with real estate markets if price does start to come down. But if we can get things moving, I think that's a positive surprise to the economy. Even though I'm in the hard landing recession camp, I think most people should be in that recession camp and defensive overall in markets right now. I'm not ignorant to the possibility of upside surprises. I just don't think there's many upside surprises we could get. But in the housing market, that is a big one. Now, the bad news we got today was again in manufacturing. We just got the Richmond Fed manufacturing data that shows employment is starting to really get bad. Factory jobs essentially are starting to be hemorrhaged, and we're down to some of the lowest employment statistics in manufacturing we have seen since the great financial crisis. And the Kansas Fed manufacturing data today really just reinforced manufacturing's in a bad place. Manufacturing index came in at -18. We were expecting +9, and last month was +6. So like just from last month, you've dropped 24 points on the Kansas Fed manufacturing index collectively. That's not good. Kansas Fed composite index was expected at +2. We came in at -8. So just across the board, bad news for manufacturing, and that's the bad news of the day today. Now, we did get more China stimulus news. The news today is China is reportedly considering a $142 billion capital injection into the country's big banks to encourage lending. There was verbal support from China's Politburo, I don't know if I'm saying that right, which said on Thursday that it would make efforts to boost the capital markets, utilize fiscal spending to support the property sector, and would use, quote, forceful interest rate cuts if required. So this is helping to boost Chinese stocks yet again today, excluding Tesla, that's down on some news of insider selling. But it's one of those scenarios where if China has to stimulate this much, do they see a bigger problem ahead? It's kind of like if Jerome Powell, 2 weeks ago came out and gave us a 1% rate cut or a 200 basis point rate cut. It's like, is that really just trying to, recalibrate policy, as the Fed would say? Or is there a larger problem? And I think that's kind of some of the issue with the Chinese stimulus. Like the first measure is like, okay, they're doing something. Now, this one is like, okay, do we have a problem? If there is more Chinese stimulus, then it's going to be an even bigger head scratcher. But for now, I think the markets are generally taking this China stimulus news as a positive, but some people are starting to get a little nervous. Here on the day today, you can see the percent of stocks currently trading above their 50-day moving average. This is a measure that I like to look at for market breadth, really the internals of our markets. If you have stocks breaking above their 50-day moving average on any given day, that tends to be a good day, right? That tends to mean broader markets are doing well, not just the Magnificent Seven or certain areas. So today you have 62.5% of stocks currently trading above their 50-day moving average. About 6% of stocks are breaking above this 50-day moving average today alone. So you're up 10% on the day today. This is really just showing the strength of the internals in our markets. Where again, as I've said here on this channel, markets are pretty well priced for perfection as a general statement, the S&P, the NASDAQ, okay? But other areas are not priced for perfection, like cyclicals and small caps and biopharma, right? Some of these more interest rate sensitive areas, some of these areas that depend on the economy doing okay and credit markets staying open and available. These areas are not priced for perfection. So as you're getting this relatively good economic news, this economic data, stimulus in China, it is helping to support areas of the market that have not done as well, like Dollar General's ripping higher today. CVS is ripping higher today. Okay, these are just some names that I personally own that have not done well recently, and they are cyclical in nature. They do well if the economy does well. They're outperforming, whereas big tech, not so much. Nvidia's red, Meta's red, Microsoft's red, Amazon's red. Google is up about 0.5%. Apple's up 1/3 of 1%. Like, this would be what I would expect if we do have a soft landing. Big tech sell off or maybe underperform compared to the RSP, for an example. The RSP today, the RSP, if you guys don't know, is the equal weight S&P, is up 0.7%. The S&P is up 0.2%. So the internals of our markets are actually pretty good today. And again, this is in line with what I've said here on this channel as of lately. If you want to be invested in our markets, you want to be in cyclicals, you want to be in small caps, you want to be in areas of the markets that benefit from an economy that does well, the economy that, you know, kind of even does okay, right? Because they're not priced for that. Cyclicals are priced for more of a recessionary economy, whereas I would want to stay away from big tech right now, from things that are already priced for perfection. Because again, as an equity strategist, which that's what you are if you are in the markets picking different stocks, it's all about what's priced in and where stocks are currently priced. The S&P is priced for perfection, very little room for upside surprises. Whereas internally, again, some areas are priced for perfection, like big tech. Some areas are not, right? Some areas are priced for the opposite, are priced more kind of for a recession, like Dollar General, for an example. If there's a surprise to economic activity, then those areas can do okay. Or even if, you know, things are not perfect out there, then they're already mispriced for the downside. You can see today CNN's fear and greed indicator is moving closer to extreme greed territory with a reading today of 72. Anything above 75 is extreme greed. Market momentum is in extreme greed. Stock price strength, extreme greed. Stock price breadth, extreme greed. Put and call options, extreme greed. Market volatility is neutral. Safe haven demand is greed. And junk bond demand is in fear. So a lot of your different components out of these 7, 1, 2, 3 of them are already in extreme greed. The 2 and 10-year yield curve inversion is actually falling a little bit today, down from about 23 basis points uninverted, now only uninverted 19 basis points, which is actually a good thing. Although 10-year treasury yields continue to rise, 10-year treasury yields today up about 2.5 basis points, now sitting at 3.80%. Now, oil today is a pretty big story. Oil is falling 3%, with Brent also falling almost 3%. That is because OPEC Plus says they are likely to go ahead with planned December oil output increase, as impact of hike is small given expected compensation cuts by some members, two OPEC Plus sources say. Basically, OPEC is considering just raising output. So more supply, presumably the same demand, means lower prices. Today in After Hours, we do have earnings from Costco, Vail Resorts, BlackBerry, and Scholastic. Now, Costco is going to be important because Costco's almost a $400 billion company at this point. They've done very well over the past couple of years, and Costco is another one of those companies seen as kind of a bellwether to the state of the U.S. economy, specifically the consumer. If Costco has negative things to say about the consumer, well, I can't imagine markets are going to take that as positive. Or if Costco says the consumer's doing just fine, they report good earnings and say that, raise guidance or something, then I think that's going to get people even more optimistic. So all in all today, I actually think things got stronger for the bull thesis. Now, I am expecting some kind of election correction in the second half of October, but I think, again, between now and the second half of October, markets can do well. I'm not expecting much upside for the headline S&P because you're so expensive, you're priced for perfection, but internally, cyclicals, small caps, I think those areas can do very well between now and the second half of October. The bigger question remains, is the economy actually going to hold up? Are we actually going to head into a recession or not? And I don't know if we'll know that for at least the next couple of months. I'm more concerned about November, December, January, February, and March. As I've said here on this channel, I think in that time frame, we will either know if we're heading into a recession or actually going to achieve a soft landing. But again, today was good news for the bulls, and you can't argue that. Unless you're like me and think the data is just not accurate anyways, in which markets don't care about my opinion. So structurally, today was positive if you're in the bull camp. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.